Alright, so this video is about segment elimination for managerial accounting, chapter 23. So this video focuses on deciding whether to eliminate a department or segment that is performing poorly or whether to not eliminate it. So, we must look at segments' avoidable and unavoidable expenses in order to decide or even begin to consider which segments to eliminate or not. So avoidable expenses are expenses that you can escape when a segment is eliminated, and the same goes for unavoidable expenses. It's just vice versa. The expenses that you cannot escape if a segment is eliminated. So one example of this is in the book, page 993. Where Fast Track is considering eliminating its treadmill division. The reason why it's trying to eliminate it is because its expenses are more or higher than its sales. And its expenses are around $48,300 while its sales are $47,800. So this is a good reason to want to eliminate a segment. However, there are a lot of other aspects that go into deciding whether to eliminate one or not, besides just financial and things on the surface. So, this graphic shows that even though Fast Track can escape $41,800 expenses, avoidable expenses, that it would still lose $6,500 in its net income, because these are still unavoidable. So, even though it would be smart to save this money, it would still lose some, and those are just avoidable expenses. Like, for instance, depreciation, rent and utilities, insurance expense, share of office department, and purchasing expenses. So some of these don't have to do with the treadmills and the sales and stuff, but it has to do with the rent space and depreciation for equipment and things like that. So, some other things to think about when deciding whether to eliminate a segment or not is even if a segment is unprofitable on its own, it could still contribute to the sale of another product, such as if they were selling treadmills, and if they eliminated that, it would take away from the sales of water bottles, for instance. And so they might want to keep around some treadmills, maybe, to keep the water bottles flowing and being sold. So, another profitable segment could be discontinued if its space, assets, or staff can be more profitably used by expanding segments that already exist or by creating new ones that had higher potential than the ones being eliminated. So in this case, these could be added on to a different segment so that they wouldn't be necessarily losing money. They would just be putting them over into another segment where they could transfer this into profit because they wouldn't be wasting it. But they would also save all of this money too. So deciding whether to eliminate segments is not just based on financial facts or appearances on the surface. You have to look a little bit deeper into direct relationships and other aspects of segments that might not be as obvious. And that's it.